the people at the Heath School of Economics have been playing in helping raise funds for humanitarian aid in the Ukraine. It's an enormous honor to be here playing my small part in supporting Ukrainian academics. It's also a pleasure to introduce Alex Imas, who will be talking to us for the next hour. Alex has been doing groundbreaking work on many different areas, especially behavioral finance and the economics of discrimination. He has this rare ability to combine theory with field data, lab data, and observational data. And today he'll be talking to us about behavioral finance, which is this flourishing area that combines elements from psychology into financial markets. So I'll be moderating this talk. If you have any questions, you can either raise your hand and we're going to unmute you, or you can send questions through the Q&A and I'll forward them to Alex. Alex, the ground is yours.
So can everybody hear me? Great. So thanks a lot. I'd like to also echo Daniel's point about how inspiring it is that this seminar series is launched, and just wanted to again kind of reiterate my support for the people of Ukraine. It hits close to home as I was born and raised in Moldova, which is a little bit south of Ukraine. So this is all very very emotional for me personally. So with that in mind, I'd like to thank the organizers for inviting me and for having me give this talk. And today I'll be talking about heuristics and performance of financial market experts. And a lot of this work is joined with Klakow, who's now at the IMF, Rick Mascio, who's the CEO of Inalytics, and Larry Schmidt, who's a finance professor at MIT. So there's a rich literature that many of you are probably aware of heuristics and biases of individuals, basically looking at how people make decisions and how those decisions potentially deviate from the predictions of normative models. So for example, things like loss aversion, present bias, things like that. And in that literature, behavioral finance has emerged as one of the most successful branches of behavioral economics that incorporates this heuristics and biases program into economics. And one of the reasons because behavioral finance being so successful is essentially the data. There's numerous behavioral biases that have been documented in markets with repeated and consequential decisions among investors. So people who have skin in the game, they're making their own decisions with their own money over and over again with opportunities to learn. And yet we still are documenting these sorts of deviations from the normative models, such as things like the disposition effect, which was documented by Sheffrin and Statman in 1985, and more recently by Terry O'Dean in his 98 paper, which is this tendency of investors when they're holding a stock that's gone down in price to be less likely to sell it than when the same stock has gone up in price. There's literature on overconfidence, on sensation seeking, of investors having limited attention, something that we'll come back to in this talk as well. And just in general, a failure of asset prices to reflect the public information, or basically information on evidence on information processing friction, such as overreaction, underreaction to information, things like that. But despite this flourishing literature, there's still been quite a bit of pushback on some of this research, and the pushback has largely come from the fact that 99% of the evidence, at least in the individual investor space, has come from non-experts. So these are retail investors in the Terry O'Dean data set. So these are folks who kind of go on E-Trade or Robinhood or the equivalent, open up an account with $10,000 or something like that and trade. Some of the other evidence is on day traders, again, fairly small accounts. And there's also data on basic households, so kind of how households make decisions. These folks tend to hold modest portfolios, and they tend to lose money, especially relative to the market. And so there's this dearth of studies unlike and I'd like to contrast this with the literature on corporate decisions, which Ulrike Malmendier has been doing, but at least in the kind of asset pricing individual investor space, there's been a dearth of studies on smart money of investors. So essentially kind of people who are holding large portfolios, who are making decisions after being trained in this space, who are basically trading because it's their job. And as a result, the finance literature, at least the theoretical part, essentially considers investors' biases almost as like noise. And the models of institutional investors considers them as these rational normative beings, and which essentially leads to the fact that if the smart money is rational, potentially these biases don't matter too much for markets because they will be corrected. Any sort of mispricing will be corrected by institutional investors kind of coming in and ironing out these sorts of things that retail investors might be doing. So the motivation for this line of work that I'm going to be talking about today is the fact that largely these inferences that experts are rational and normative comes from data limitations. Particularly in this paper, what we're going to do is we're going to have a unique data set with daily holdings of trades of what most would consider financial experts. So these are institutional investors with large portfolios. And what we have in the data set is their entire portfolio and essentially what they do throughout the day with that portfolio every single day for quite a while. We study the performance of their buying and selling decisions separately for reasons that I'll explain in a minute, and we can characterize their buying and selling strategies to potentially identify whether they're suffering from particular biases or heuristics. And what the richness of the data set also allows us to do is to quantify potential costs of heuristic use as far as looking at performance. There's a question?
Yeah, sorry, Alex. I missed how you're identifying the experts. These are professionals, or are you looking at qualifications? Like
these
CFA
are professionals. These are institutional investors. So these are professional portfolio managers.
Okay, thank you.
So think. I think so this is the slide. So these are institutional investors, and what you should be kind of thinking about is a professional portfolio manager who has like something like a pension fund that they're managing. That's kind of the most common. The modal person in our data set is somebody who's managing a pension fund. So these are active managers, and these are long-only portfolios. So what that means several things that's going to make our analysis a lot less complicated. We have 783 of these institutional portfolios in our data set. We observe their holdings and their trades, again, on this daily basis. And we have data observations from 2003 to 2016. The modal observation is a portfolio managed for single clients. So again, this is kind of like a pension fund. And the vast majority of the data is collected in real time as it's coming in. One thing to note is that we are confident in calling these people experts because this is a positively selected sample that essentially chose to have their performance evaluated by Inalytics in the first place. So these are people who are on average are beating their benchmark at 2.5 at a rate of 2.5% per year, which is quite a bit. This is 250 basis points per year consistently. So this is a positively selected sample. So if we kind of find heuristic use among this sample, this gives us some confidence that it's even more prevalent in kind of the general institutional investor space. Yeah, question?
Yeah, I have two questions here. So are you tracking the same institutional strategy or the same institutional representative? Because the reason I'm representative, so it's the same person making the decision, and it's not like some committee making a decision and they're just implementing.
It's the same person making the decision.
Perfect. And the second question is, some institutions, depending on their status, have very different risk return profiles by law, or let's say by regulation. For example, a pension fund cannot invest in highly risky stuff. So are the performances different consistently across these institutional groups, or do they play a role in the analysis?
So we take a look at heterogeneity in the analysis. One thing that we can say is that all of them are long-only portfolios and that's their mandate, is essentially they can't short is one thing they can't do. We have a few hedge funds in the data, but this is a minority. So the kind of mandates that these folks have, and we have heterogeneity as far as the sort of kind of the style that they use, which we can kind of back out from the data. But as far as kind of like, do we have like super risky strategies here of the sort where they're like, you know, trading complicated derivatives and things like that? That's not the sort of thing we have.
Okay, thanks.
Yeah. Daniel?
So do they select to be part of your sample after or before they see the return?
They selected to be part of the sample, they selected to be tracked as part of the as part of their performance review. So essentially, either client usually contracts analytics to say like, look, I want to know how well my portfolio manager is doing. And the portfolio manager and their organization has to agree to this. And so the agreement comes from the fact that they're fairly confident that they're doing well. So they already know that they're getting these 2.5% returns. Any other questions? Cool. So the total market value of all of the portfolios in our sample is about $500 billion. The mean portfolio in our sample is 573 million, and that's got a fairly big tail. So we have billion-dollar portfolios in our sample too. And you know, I just want to contrast that to kind of like the other data sets out there. So the median portfolio in the Odin data set is something on the order of $10,000 or $20,000. So these are much larger players. They also are much more diversified. So they're holding about 83 different stocks. In the Odin data set, this is around 8 to 10. And they have much longer holding periods. Their holding period is the average holding period is 561 days. We have a lot of trades. We have 4.4 million trades. And that gives us about 90 million kind of stock fund date observations. So we have quite a large data set to work with as far as doing this sort of analysis. So to motivate why we're going to be thinking of buying and selling as two different, analyzing them separately, is that there is some at least conceptual literature on arguing that these are different types of psychological processes involved in a buying decision versus a selling decision. So Matt Levine, when this work first came out as a working paper years ago, he wrote a nice column about it in Bloomberg, and kind of he echoed this as far as working as a practitioner in the field. And he said that if you hang around financial markets, you get all sorts of advice about how to decide which stocks to buy. And almost all of it comes down to some sort of fundamental analysis of the underlying business. But you get some advice on selling, and a lot of this advice will be very, very heuristic. So for example, you know, cut your losses and let your winners run is a thing that people say, which has nothing to do with the underlying business. If you double your money, sell and take profit. This is what Barron said. Notice that this is different. These are two different strategies. The basic folksy rule of thumb is buying is about fundamentals, kind of thinking through what to add to the portfolio based on the business, and selling is more about price action. And so this is something this is something that Matt talks about, and this is something that Barber and Odin also raised as kind of thinking about what sort of thinking process goes into a buying and selling decision. But notably, Barber and Odin had only access to retail traders, and for retail traders, you know, both sets of decisions kind of looked relatively similar. They weren't very well thought out in either case, because again, they're looking at non-experts. And because we're working with analytics who gave us this data set, we actually have access to some of these, some of the folks here after we've already, you know, started analyzing the data. So we decided to interview some of them and ask them about sort of what goes into their buying and selling decision. And their selling decisions were, these are a few choice quotes. When I sell, I'm done with it. In fact, after I sell, I go through and delete the name of the position from the entire research universe. It's out of my portfolio, it's out of my hands. This suggests that they're not really trying to track the things they're selling as far as, was this a good decision or not? Selling is simply a cash raising exercise for the next buying idea. So they're kind of viewing it as almost like, all right, I'm liquidity constrained, so I need to basically get rid of my portfolio. I need to sell in order to buy something. And you know, the last quote is really captures everything that I'm going to be talking about today, which is that buying is an investment decision, selling is something else. So that kind of motivates why we decided to evaluate these things separately. And so what we're going to do is evaluate trading performance, but we're going to be using a slightly different way of analyzing it, because it's the benchmark is, because these are active managers, we can't really use something like the benchmark as a good counterfactual to evaluate performance, because a lot of the time their portfolio is so is pretty far away from the benchmark. So selling a benchmark or buying the benchmark isn't really within their option set. So what we wanted to do is to use a feasible counterfactual, something that these people can do while still having it be a conservative counterfactual for looking at performance. So what we do is we hold a holding period H, and we're going to be varying H, and compare realized returns of the actual decisions that they made to the feasible alternative strategy. So let's say they made some decision at T. We're going to look at, all right, here's a feasible counterfactual that they're using over the same holding period. We're going to use a bunch of these different counterfactuals. That's kind of the main exercise of the paper. And then we're going to be comparing that to what they actually did. So the main kind of counterfactual that I'm going to be talking about, and again, we have different ones in the paper, instead of an actual stock traded, we're going to randomly trade one of the pre-existing positions in the same direction. So what that means is, for selling, for example, we're going to take one of their decisions and we're going to say, all right, I know you need to raise some money based on the decision that you made to sell. What we're going to do instead is throw a dart at your portfolio and sell something else in your portfolio for the same money instead. And obviously we can do this in a more nuanced way than what I'm saying, but that's kind of the basic idea. There's a question in the audience.
Yeah, so I was thinking about this. Normally the benchmark has to be something that you would do otherwise. And the reason I was asking about the type of institutions is that, for example, like super simple. You have one investor that invests according to some Markowitz criterion, and then you have another investor like a pension fund that has an asset liability management position that has additional constraints.
Yeah.
And normally we don't really see them. We just see stuff that has happened and we don't really know why, in a sense. So, what's feasible for one might be completely different, not even in terms of feasibility considered for another, just depending on their type.
Yeah, so, no, I totally agree with that. And again, we don't have access to their mandates, which is important. What we can do instead is run just about 30 or 40 different counterfactuals to constrain the sort of things that they could potentially sell. So for example, here I'm saying, randomly trade, but we can say instead, like, let's say their sector, they need to be, a certain amount of their money needs to be invested in certain sectors. So we can say, instead of, I saw you sell a tech stock, I'm going to choose randomly within the tech stocks that you own. Or let's say you need a certain tracking error to maintain it. So we're going to sell something while keeping the tracking error constant. Or your portfolio needs to match factors in a certain way. You're going to create a factor neutral portfolio, sell from that instead. So that's kind of the exercise in the paper, is to say, look, we know that these people are probably constrained based on things we can't see. So let's try a bunch of different things and show you that it doesn't really matter.
Okay, thanks.
Alex, if I may, I thank the host for promoting me to be able to do this in person. I was really amazed at the inconsistency in the interviews, in the sense that if I'm using fundamentals to decide what to buy, and I have that level of sophistication, shouldn't I use fundamentals to look at what I'm holding with some posterior beliefs to decide what to sell?
Yes.
And in your interviews, have you tried to kind of follow up just to see, like, when you raise that, do they like pause and try to defend themselves, or do they just admit that ex ante, we do research, ex post, we just follow our guts.
Yeah, I mean, so I actually got a chance to present this paper to the people in the sample. And once we were done with the paper, I went to a conference that Inalytics was holding, and I presented the results. And I mean, they were very surprised by what was going on. And a lot of the conversation that I had after the presentation were, okay, so like, you know, we're really focused on buying. We admit that we should be doing more on selling. But that's not really what we're hired for. That's not like the conversations we're having with the pension funds or our clients. Where the conversations we're having is like, oh, look, that thing that I added to my portfolio, isn't that awesome? They're not having conversations like, oh, look at when I sold. If I didn't sell, I would have been really screwed, or something like that. So I think they thought that they were probably doing worse on selling than buying because they weren't paying attention to it. But I think they were surprised to the extent that they were doing worse. But I mean, as you said, it's like literally the mirror image as far as the decisions. When you're writing down a model of, you know, investor behavior, selling is the mirror image. And that's not at all what's happening here.
So Alex, this suggests that when they communicate with their clients, what they're trying to do is tell a story rather than just show risk-adjusted return numbers. So look at what we have in our portfolio versus look at what we didn't put into our portfolio. I mean, so that may be interesting as well, isn't it? That there's a strong narrative component rather than just showing the numbers.
Yeah, I think that's something that we talk about in the paper to try to explain this discrepancy, and that's something that there's a really nice book by the person who managed the Yale endowment, talking about what the institutional investor process is. And a lot of the sort of process he talks about is, yes, we're going to be really focused on earning returns on like what we add to the portfolio. Very little of it is on selling, like almost nothing in the book. And also there's a large component of the narratives that they're talking about with the companies that they're adding, taking them to lunch, going to golf, all of this sort of thing. It's a really big part of the process that I think is completely outside of the models. We're not really focused in the paper on this. We're just kind of highlighting this discrepancy, but I think this is a really important thing to think of.
Sorry, just to follow up and be the card-carrying theorist here, if you're putting this as a heuristic, but is this just a sort of incomplete contracting problem of some form? I can be contracted on the stocks I put into my portfolio, but I can't be contracted on, you know, the counterfactuals of what happens to the stocks I took out of my portfolio, and that's
the contract is based on your returns, right? So if you're losing out on X returns, you're going to get a lower bonus.
No, fair, but let me think about that.
That
Yeah,
even
I mean,
makes
I
things
think
more surprising, because if they're leaving money on the table, it's coming out of their pocket.
exactly.
But it's base. So the base is AUM, and so if you keep your AUM big, even if you're earning lower returns, then your comp is staying high. Is that right?
Your comp is staying high, but your comp is based on
It's AUM plus
the bonus
excess
structure.
Sure, but if you're retaining the trust of your clients, even if you're underperforming, then you're still.
Yeah, sorry, I missed the
last I guess the question. I mean, it is inconsistent, but I guess the question is where the bias is. Is it the client that's paying attention to the stock that's added, but not the stock when you buy, not to sell, or is it the manager that's paying more attention to the stock that you buy than resell? Someone is not paying attention.
I think if you ask these guys and you tell them, look, instead of 2.5%, you could be earning 4 or 5%, which is what we're finding. Which they're losing. They're basically leaving their entire management fees on the table. That would potentially, given a client relationship, that might not, on the intensive margin, maybe that doesn't matter, but that's certainly going to matter for attracting clients. If I'm performing 4 or 5% consistently versus 2.5%, they're leaving money on the table. So again, the approach is not standard in the sense that these are not, which are a lot of the approaches use benchmark adjusted returns, and that's because they're not holding the benchmark. So a lot of the sort of performance evaluation studies out there have been looking at things like mutual funds who are holding the benchmark plus other things, or retail investors who it just compares their returns to like the S&P, which is the other counterfactual that they could be holding. We try to give them a conservative and feasible sort of benchmark that they could both sell while still being fair to the fact that these are fairly sophisticated people. So the first question is there skill in buying? This is not a really obvious question because of the fact that, we have this mutual fund literature that suggests that there isn't skill in buying or selling, that the mutual funds are generally not really outperforming the market consistently. But again, these are active investors, and as we saw, they're earning 2.5 above their client benchmark. So there might be skill somewhere along the line. So what we can do is we can compare buying to a reasonable counterfactual, and we find that these guys are actually quite good. If these numbers move around depending on the counterfactual that we use, we are consistently seeing fairly large returns given this sort of counterfactual. And here again, this is not the benchmark. These would be much higher if we use the benchmark. This is their own potential holdings. So whenever they add something to the portfolio, not whenever, but when they add something to the portfolio, on average, given the counterfactual, they're adding value. So this suggests that there's research being done, and whatever they're doing in deciding what to add to their portfolio is actually is adding value. So and this seems to be growing over the sort of horizon that we're thinking about. So there seems to be skill in buying. So do these skills transfer to selling? These are long-only funds. So again, they're liquidity constrained in the sense that if they're buying something, they need to sell something. They're typically not holding cash positions, that the client's not paying them to hold cash. So it's unfair to compare selling to something like the benchmark. So what we do is use in our baseline specification a no-skill strategy of randomly selling alternative stock. They should be beating the no-skill random selling strategy, or at least some of the other strategies that we're using. And that's the question that we're asking. And what we find is that they don't. They do worse than random. So this was kind of the big headline of the paper, is that when you're looking at counterfactual returns as far as their selling decisions, they're really bad. They're doing worse than me throwing a dart at their portfolio and selling that instead. So it seems like whatever skill that they're using to buy is not being transferred to the selling side. And in fact, not only is it not transferred, they're somehow doing worse than random. So the answer is that the question now becomes, how are they doing worse than random? And just as a robustness exercise, we can look at a bunch of different ways that I hinted at that before. We can repeat the analysis in different subsamples of only looking at developed markets, looking at systemic risk differences. So for example, making sure they're selling things that have load onto the same factors as the counterfactual. We can look at the size of the trades. We call these divorces. These are like larger trades versus smaller trades. The larger trades seem to be even worse than the smaller trades. So if you're interested in this took a very long time to kind of convince ourselves and others that this is a real performance difference. But I think hopefully we've done that with the various counterfactuals we've used. So what do we, Daniel?
Is there any correlation between how well they did on the buy and how poorly they did on the sell?
No. Which was surprising to us. That's one of the first things we looked at. Another question?
Yeah. Is there any way to sort of check what triggers selling decisions? I mean, for the buying, you mentioned, they're doing the research, maybe they have some strategy, some timing, et cetera, et cetera. For the other ones, is it selling that always happens like 1-2 days before companies report, 1-2 days after? I mean, is there something particular that it would be interesting to understand what makes them be wrong in a sense.
Yeah, so that's what we do. So we're going to be doing that later on. We're going to be looking at different types of cells. So cells that we think is like a cash raising exercise versus like, well, cells because they have some information and they need to get rid of this. I'll preview cash raising is what's driving this.
Okay. And actually there might be some, like you can set up your own fund if you go long on what they're buying and short on what they're selling. You could actually make that as a benchmark for them to beat. Because it looks like the performance over a year and a half, it's quite big between the two.
Mm-hmm.
So that would almost become like a natural, benchmark. But the problem is you're the only one who can see this backwards, right? Like not all of them see the market at the same time to aggregate all of that information, to aggregate the biases.
So yeah, so we can set, like, given the data we have, we can certainly, quote unquote, make money off of it. But obviously, this is not public information. So it's not like somebody can use this information and make money on the market, because this is very dependent on their holdings, and we don't have that's not public information. So our argument is that managers use a heuristic process for selling but not buying. And what we show is that the results I'm going to show you is consistent with this asymmetric allocation of cognitive resources. So the first thing, given this sort of argument, the first thing that naturally arises is, do they have some sort of fundamental lack of skill in selling? Is there something about selling that's kind of fundamental to the decision problem, rather than just not paying attention to it, which assumes that if they did pay attention to it, they do quite well. So what we do in the paper is look at events where the portfolio, we with some confidence, we think the portfolio manager might be paying more attention to selling. So one of the things that in the literature that's been shown to be a driver of attention is earnings announcement days. So if a firm has an earnings announcement day, people are paying attention to that firm. So we think the portfolio manager might think like, oh, there's an announcement day. Let me look at my portfolio. Let me try to incorporate that information into my decision. Maybe I should sell that based on that information, or make some sort of selling decision. So we can look at both buying and selling decisions on earnings announcement days to see that, let's say the announcement allocates more attention to selling. Let's see what happens. So here's what happens on non-earnings announcement days. This is kind of a replication of what I've already shown you. So the buying is good, the selling is bad. Let's look at what happens on earnings announcement days. Here's the graph of what happens to buying. Buying doesn't change. So essentially, this is the difference between announcement days and non-earning announcement days for buying. This suggests that, look, they're already paying attention to their buying decisions. Extra attention doesn't really affect anything. For sells, this is quite different. So the sells actually start looking almost just like buys as far as the added value when they're selling during times when we think that they're paying attention to this decision. What this suggests is that, again, consistent with this sort of asymmetric allocation of cognitive resources, that it's not something fundamentally different about a selling decision versus a buying decision. It's more that their attention is constrained, and for reasons that we can speculate on, they're not really devoting a ton of cognitive resources on a typical day to their selling decision. So it's not like they don't know how to sell. So the rest of the kind of paper, of the sort of exercise is going to be kind of trying to figure out, like, what are they actually doing when they're making selling decisions, and why might cells underperform? The question, yeah, Daniel.
So if you go back one slide, you're doing the reference point here is how much less bad they do, but do they make money out of the cells when that happens, or they're not? They're just doing it randomly when they pay attention.
No, they do better. So you can see the point estimates are around 2 or 3, whereas here they're around 0.5, 0.1.
Okay, so it's relative to 0. It's not relative to how much you lose to your average performance.
Yeah, exactly. So they're actually adding value with their cells on announcement days.
Okay.
So Alex, what this suggests, and I don't know much about the institutional details, you have this portfolio manager who's making decisions. And it seems that they are constantly, or at least with some frequency, looking at stocks that they don't own to see what they should buy. Then they find something that on fundamentals looks good. They seem to be doing a good job based on what you showed us. But then when they sell, they just don't have the bandwidth to get information. And when that information just pops on their lap through earnings announcement days, then they actually take that into account. So given the magnitude of these funds, would one simple strategy be every portfolio should have a buy manager and a sell manager, that one person is constantly looking at what we don't own to decide what looks good, and the other person is looking at what we own to update on fundamentals?
Right. So that's exactly our conclusion. But one thing to add to that is that even when they buy stuff that they do own, like add something to their current position, that's still pretty good. So their buying decisions are just psychologically different than their selling decisions, even when they're buying on top of holdings. Now, the things that they buy that they don't hold, those are the best decisions. That adds a lot of value. But when they add to current holdings, that's still pretty good. And that's kind of a separate paper that we're thinking about writing, is about the research process itself, is about saying like, all right, so research seems to be doing something here, which is important to document. Question?
Alex, I was wondering, so you were mentioning information, bandwidth, and so on and so forth, but once you own it, the type of behavior when they're reluctant maybe to sell, even though they've learned something bad, might go along the lines of some form of prospect theory as well, right? Because you already have it, your reference point is there, and maybe you're gambling on some revival or something like that, right? So, and I'm just wondering, could we like understand which one of these two is playing a role?
And that's exactly what I'm going to show you. Okay. The answer is both.
Awesome.
The answer is both. Question?
Yeah. Do we know anything about the correlation of buy decisions? I mean, one story would be that there's this new stock, it's incredibly hot, everyone loads up on it. And because Perfect. Everyone's loading up on it, and because these are large institutional investors, they move the price. So they sin in haste, and then as time goes on, they're freeing up liquidity, and they make individual uncorrelated sell decisions.
So that's something so this is a price pressure argument, and that's not what we have here. So we looked at cross fund correlations. Okay. So the answer is the nice thing about this data set is that these guys are big, but not that big. If they were too big, that'd be a problem. Or if they were largely, all of this was coming from illiquid stocks, that would also be a problem. Because if it's stocks illiquid, one big guy is making a big trade, him making the big trade is pushing the prices up.
Sure. So you can look at the liquidity of the trades as well.
Exactly, and that's something that we do in the paper.
Fantastic.
We do a lot to try to rule out this price pressure explanation.
Great, thank you.
Yeah. So what are they selling? So Barber and Odin, so this point was just raised. Basically, they argue for this two-step trading process. They argue for this for both buying and selling. And as I'll show you, this doesn't apply to buying, but this describes selling very well. They have a limited attention they have a constrained consideration set to begin with of what they're considering selling. And within that constrained consideration set, they use heuristics and biases to decide what to sell. So the first piece of evidence I'm going to present to you is that this limited attention constrains the consideration set. And I'll show you what they're selling is the things that are salient on extreme attributes. Particularly, these are things that are very salient on their trading screen. And these are the things that they consider selling when they decide what to sell. what's one of the most salient attributes. We can look at the literature to see what kind of things have been looked at in the past. The things that these people are looking at constantly is prior returns. That's what's on their screen all the time. This is something that Sam Hartzmark documented in 2014, what he called the rank effect. So the things that are kind of most salient are things that have the most extreme returns. So things that have gone up quite a bit or gone down quite a bit, so given some sort of benchmark. So what we do is we sort positions into 20 bins based on past benchmark adjusted returns and compute the daily probability of selling something when it's in the extreme bin versus when it's somewhere in the middle. And the nice thing is we have a natural control for comparing these things because we can also compare the selling decisions to the buying decisions. If attention is kind of only constrained on the sell side, but not the buy side, we should see these salient attributes playing a large role for selling, but a smaller role for buying. Malesh?
If returns made me think, tax treatments, could that have a role to play?
So yes, but not here. Okay. These are pension funds, so everything's tax exempt. Okay, so let's look at buying strategies. We're ranking things from worst loser to best winner. Looking at that propensity to buy something as a function of prior returns, we get this nice little flat line. These things aren't playing a huge role. We can look at buying for existing holdings. We can look at buying for new holdings. We don't find prior returns having almost any effect on buying decisions. What do sell decisions look like? Quite different. So these are the selling decisions. Much, much, much higher probability to sell something when it's in the extreme bin than when it's somewhere in the middle. So what this suggests is that they're much more likely to consider something to sell something when it's an extreme performer in their portfolio.
So Alex, this is really interesting. You chose what to look at here, loser, winner, based on the salience. Given the size of your data, this seems to be like one application where you could throw a pretty heavy machine learning apparatus at it, with many layers of trees to some random forest or whatever you want, and literally throw in the kitchen sink and see whether, take part of your data, train the model, and see if you could get a pretty good prediction model of what they would sell as part of their portfolio.
Yeah, we haven't done that. But you're totally right. The size of our data and the richness of the data, and we have much more data now actually, suggests that we could do that, but we just haven't. And also just to, we can do this for a whole variety of horizons. This is since it was added to the portfolio, this is just based on 1 week prior returns. Again, these are things that are on their screen that they're tracking. So based on what's salient on their screen, these could potentially have an effect, and we show that they do. We can do this for a year, quarter, even over the daily horizon. It's having an effect on selling. It never has any effect on buying. So there's a lot of.
I know I'm monopolizing the questions, but one thing that I was wondering here, if I think of a story of mean reversion, which obviously would not be true, that should suggest that if you look at the performance where you replace the worst loser to the randomness, right? And if the worst loser is just an unlucky day, that should be a much worse performance. I hope I'm articulating myself reasonably, than if you would compare the sales of the best winners who, when you sold them, they did exceptionally well, and they will mean revert, and then compared to randomness, that would actually have been a good sell. Does that make sense?
It does, and we can do that sort of like which side is driving the poor performance. It turns out not to mean a huge. This isn't just a bad strategy. So what we show because this is not really what's driving the underperformance. This is just what's driving what's being considered. I'll show you in a bit what's actually driving the underperformance, because you could think of a story where like this doesn't really matter, right? If they're just selling randomly out of a constrained set, so they do just as well as random. This doesn't say why they're underperforming. So that's going to be kind of the next step, is to find out, okay, so they're more likely to sell out of these bins. Given those bins, why are they doing worse than random? What this does first is to offer some credence to this attention story. We can do a lot of things to try to rule out different explanations. So Malesh already said taxes. These are not taxable. Omitted variables like position size, holding, risk management. You can double sort on these variables. We can control for stock characteristics. So a really neat thing to say is to basically show that we can replicate this for the same exact stock, because for Malesh, for example, this might not, I sell Apple and Malesh holds Apple. What's the probability that Malesh sells Apple? And for Malesh, Apple is not a extreme return. For me, it is, because we're holding different portfolios. I'm much more likely to sell Apple than Malesh. So we can do fund, stock, day, fixed effects, and still reproduce this figure. So it's not specific to particular stocks. It's really specific to within portfolio returns. Maybe it's the new buys or large trades to be extreme. We can replicate everything using a wider consideration set, and we see some very similar U-shape when only looking at complete sells or complete buys. So new buys versus full cuts. And just to reiterate, these are skilled people. These are people who are paying a lot of money, getting paid a lot of money to manage their portfolios. The fact that we researchers come in and predict what they're doing is a very bad signal in general. They need to be, they theoretically should be doing something based on research into non-publicly available information, or at least, the sort of information that we have. And their buying is, we can't predict their buying at all, but we can't predict their selling, which suggests that there's not a lot of skill going on there. So this was a point that was brought up earlier. How are they doing worse than random? So we have this attention story. What we show is that the attention story is combined with a sort of endowment effect. And this is really what's driving the underperformance. What they're selling is the things that they're least attached to. So what that means is that from the consideration set, we look at the low active share. The low active share assets, these are things that they most recently added to their portfolio, are 140% more likely to be sold than the average position. Why would that generate underperformance? Because their buying decisions have information. These are good decisions. That means that in order to generate value from that buying decision, they should hold on to this asset for long enough where this information kind of like leaks into the public domain, and they're no longer generating alpha from that decision. If they're selling before that happens, that is a bad idea, because essentially they're not accumulating the sort of value that they should. So in a sense, that the reason that they could be doing worse than random is because they're skilled. If they didn't have any skill on the buying decision, then their selling decisions wouldn't be doing worse than random as well, because they don't have any information, and none of this type of stuff happens. So low active share sold. The low active share sold are low conviction ideas. There's less time spent building up, getting attached to it, and so on. And this is really driving. What we show is that this is really driving the underperformance. Daniel,
it's very interesting. So basically, what you're showing is that the stocks they sell, they don't overperform the market. They underperform the stocks that they hold. Is that what you're saying?
They overperform the stocks that they hold.
Yes.
Yes.
But so relative to the market, it's not that they're picking the wrong stocks to sell, like relative to everything there. It's just that because their portfolio is so good, They should hold on to the stocks that they have had for very little time for longer to take into account the accrual of the alpha.
Exactly.
Okay.
And we can actually show that when we do observe them get rid of a stock that they've held on for a long time, as in the information, and this is because of presumably they got some information that says, look, this is a bad stock, you should sell it. This kind of overrides their endowment effect, and we show that these are good selling decisions.
So I'm wondering, Alex, if instead of the random sale that you use as a benchmark, which I agree is a very sensible benchmark, if you would then sell the stock that they held onto the longest, would they have done even better?
Yes.
Yes. Okay. This is really fascinating because this attachment story seems to be related. And again, I don't know how they operate to just holding something for a long time, even though the most recent stocks that I bought should be the ones that I would think I would feel more vested in because I've done research, I've selected them top of mind. So it's kind of a bit of a mindfuck in respect to why am I attached to something that I've just held for a long time, but the research I did was a long time ago versus something that I recently invested in time.
So
energy.
they spent a lot of time kind of building up positions. So these are the sorts of things they're continuously doing research on, to the things that are in their portfolio. The things that they've recently bought is like it is based on research because it's earning value, but it's not based on as much research as the things that are been in their portfolio for a while. Because again, they're not just buying. When I observe a buying decision, it's not that they're always buying kind of a brand new idea. They're typically buying stuff to build up the position further. And so what we show is that they're kind of they're selling these neglected ideas, and this really explains the underperformance fairly well. When a high active share asset is sold, which is what I just mentioned, these selling decisions tend to outperform the sell counterfactuals. These are good decisions. When they're selling something that they're quote unquote attached to, those selling decisions are better than the counterfactual. Sorry. So the last kind of, I think I have 5 minutes. The last piece of data that I'm going to show you is whether this heuristic can explain underperformance. So we can look at the extent of heuristic use. The proxy that we're going to use is the extent of this U-shape. And so we can look at both within and between manager variation in that. So some people have have periods where they're more U-shaped than other times, and we have managers who are more U-shaped than others, and we can look at whether heuristic use, which were proxied by this U-shape, it can explain some of this underperformance. And what we show is that, indeed it does. The more kind of U-shaped, the highest quartile of U-shapedness, or the highest quartile of heuristic use, is driving a huge amount of the underperformance. As you can see, the point estimates are quite large here. PM's propensity to sell extremes is associated with the worst selling performance. So sells from the period this is within manager data, with the highest quartile of heuristic use are associated with a 2% of money just being left on the table. So if they did just random selling during those periods, they would be earning an additional 2%, which is quite a lot for these folks. And kind of lastly, we talked about selling. When are they selling, and what are they doing when they're selling? We can do a bunch of other kind of sorts. So we can look at selling when we think cognitive resources are stretched or not being used. So we can look at periods of, for example, underperformance of their overall portfolio. We can look at, are selling decisions worse during those periods? They indeed are. We can also look at cash raising episodes when there's a lot of buying activity, and we can look at when they sell during those periods, are those sells the worst? And indeed, these kind of cash raising episodes are associated with the worst selling performance. So this leaves us with this big question that I think Steve kind of alluded to in the beginning is, these are similar decisions. Why aren't they figuring this out or using the same sort of process? The problem with selling is that it's more difficult to evaluate performance than buying, because it essentially means that you need to be generating a counterfactual portfolio of tracking the things that you're selling. With buying, you can kind of look at what you bought, you can look at your portfolio, is this a good decision or not? It's kind of right there in front of you. With selling, you need to say, like, look, I just got rid of Apple, let me track Apple for a while and see whether this was a good decision or not. And talking to these folks and thinking about like their decision-making process, they're just not doing that. They don't know that they're selling, that their sales are bad, because they're just not creating the sort of counterfactual exercises that we're doing here. And talking to other firms outside of this, very big firms with portfolio managers, this just seems to be an industry-wide phenomenon where selling is not being systematically evaluated in this manner. And if they don't have signals that their selling is underperforming a reasonable counterfactual, it's very difficult to learn. And this is exactly what we observe in this data set. We can track a fund for 10 years, and there's not really a change as far as their selling performance. They're really not learning about this. So I have a bit more data on kind of expertise and transferability, but in the interest of time, since I only have 2 minutes, I'll summarize. What we do in the paper is document heuristic thinking and selling, but not buying amongst experts. We characterize this heuristic and document the consequences for returns. And this suggests that evidence in one domain of expertise in buying doesn't really transfer even to a mirror image within the same person, namely selling, despite the frequency and despite the consequences for decisions. It seems like this that expertise is not transferred here, which implies, as was already mentioned, scope for learning and a large return to either a refocusing decision aids or hiring 2 separate portfolio managers, one to focus on selling, one to focus on buying. So that, thanks a lot. Thanks for having me. And I'd love to talk about this more.
Alex, is the paper on your website? I have a good friend who's a portfolio manager and I want to send it to him.
Yeah, it's called Selling Fast and Buying Slow.
Okay, thank you.
Yep.
Really enjoyed the talk.
Thank you.
Thank you, Alex. That was amazing. So what's the protocol now? Do we have Q&A or do we?
If people wanted to ask questions, they can throw up their hands now, and then we can stop recording once we've got the first questions out of the way, and we can have an informal chat if people want to say recorded and streamed.
So if you're in the attendee panel and you want to join, just raise your hands and we'll promote you. And till then, I had a side note, by the way. This is fascinating. Connecting to your other hobby horse of like fairness and decision making. I was talking to someone and I forget who, and apparently judges don't see the outcomes of their bail decisions. So all this story that we're talking about, judges should see that, they are potentially on the margin.